The tax implications of selling a house in a trust in California are almost never what families expect. And the most expensive mistake isn't a bad decision, it's a slow one. If you're the personal representative of a family estate here in Orange County, a clock started the day your parent died, and no one sent you the notice. Let's fix that right now. Attorneys handle the law, accountants handle the numbers. I manage what actually goes wrong in real estate life. Property, people, timelines, and conflict. That distinction matters here because the tax problem in a trust sale almost never starts in a tax office. It starts in a hallway with two siblings who can't agree while a house sits empty and the market moves. So let's talk about what actually happens. While your parent was alive, that trust was revocable. They could change it. They could sell the house. They could take it out of the trust on a Tuesday and put it back on a Friday. For tax purposes, the trust barely existed. Everything flowed through your parents' Social Security numbers like water through a garden hose. The day they passed, that changed. The trust became irrevocable. It became its own entity with its own tax identification number and its own tax return. And the house inside, it got something valuable. Something families lose all the time without ever knowing they had it. Let me share this story with you. Every house in America carries an invisible receipt. Picture a folded piece of paper tucked in the back of a kitchen drawer, behind the batteries and the rubber bands. On that receipt is the price your parents paid. Maybe it said $42,000, written in 1974, back when Orange County still had orange groves and the freeway didn't scare anybody. That receipt sat in the drawer for 50 years, yellowing, getting more and more out of touch with reality. And the whole time it sat there, it was quietly building a tax bill. Because if your parents had sold that house while they were alive, the government would have pulled that receipt out of the drawer and compared it to the sale price and taxed the difference. Now, here's the part almost nobody understands. On the day your parent died, someone walked into that kitchen, opened the drawer, took out that old receipt, and tore it in half. Then they wrote a brand new one, and the new receipt doesn't say $42,000. It says whatever the house was worth on the day of death. 1.2 million. 1.4. Whatever the market said that morning. That is a step up in basis. And it is the single most generous thing the tax code does for grieving families in California. 50 years of appreciation, gone from the tax ledger. Erased, not deferred, erased. Now notice something. The trust didn't do that. Death did that. Your parents' death is what tore up the receipt. The trust just made sure the house didn't have to sit in probate court for 18 months waiting on a judge. That's the purpose of a trust: control and speed, not tax magic. So when people ask about the disadvantages of a trust, this is the honest answer. The trust doesn't save you from taxes, it saves you from delay. And if you don't use that speed, you throw away the only real advantage you were handed. Because here's what happens next. That brand new receipt in the drawer is only accurate for one day, the day of death. After that, it starts drifting. The market moves, values climb, and every dollar the house gains from that day forward is a new gain, taxable gain, sitting on the trust books. Wait 6 months and it might be $20,000. Wait 2 years in a market like ours, and it can be well over 100. That's real money coming out of your family's pocket, and it's money nobody would have owed if the house had sold closer to the date it was handed to you. If this is something you're facing right now, subscribe for clear guidance, and no, you don't have to figure this out alone. So let's talk about who actually pays. If the trustee sells the house while it's still titled in the trust, the gain lands on the trust tax return, a Form 1041. And trusts are taxed brutally. They hit the top bracket at just a few $1,000s of income, where an individual wouldn't get there until hundreds of thousands. That surprises people every single time. Now, if the trust distributes that gain out of the beneficiaries, it comes off the trust return and lands on each other's personal return through a K-1. Sometimes that's the smarter route. Sometimes it isn't. That depends on each heir's income. And it's a conversation for your CPA, not for a YouTube video and not for the sibling who read something online. And there's one more thing families miss. That $250,000 home sale exclusion your parents enjoyed, the one that let them sell tax-free, that was theirs. It was tied to them living in the house. It doesn't transfer to the trust, and it doesn't transfer to you unless you actually live there and met the rules yourself. Most heirs don't, so don't plan around it. Then there's Prop 19. If the house isn't sold and one heir wants to keep it, the property tax picture changes fast. That low assessed value your parents enjoyed for 40 years usually doesn't survive unless the heir moves in and files on time, which means the sibling who says, let's just hold it and rent it out, may be signing the family up for a property tax bill that doubles or triples. That's not a legal argument, that's an arithmetic problem. And it usually shows up after the family already agreed. So what actually protects you? 3 things. Get a date of death appraisal, not a Zillow number, not a friend's opinion, a real appraisal done by a qualified appraiser, documenting that new receipt in the drawer. If you ever got questioned, that document is your proof. Families who skip this pay for it years later. Second, keep your records. Every repair, every clean out, invoice, every dollar you spend improving the property before sale can adjust your numbers. Save the receipts, all of them. Third, and this is where we live, deal with the property and the people at the same time, because the tax clock doesn't pause while your family works through grief. It doesn't pause while you argue about the furniture. It doesn't pause while one sibling stalls because selling makes it feel final. That's the part nobody prepares you for, and that's exactly the part we handle. Estate cleanouts, vendor coordination, contractors, mediating between heirs who love each other and still can't be in the same room. Getting the house market ready without spending money that won't come back. Grief creates urgency. Probate punishes urgency, but a trust rewards steady, informed action, and that's what we're here to help you take. This is not legal or tax advice. This is spoken in plain English for education, so you can ask better questions and avoid costly mistakes. Need help with estate cleanout, maintenance, or referrals to a CPA or an attorney? Reach out. I've got trusted resources to guide you.